Now we're going to look at the second method under the non-discount approaches, which is accounting rate of return or return on capital employed. Now I'm going to explain what it is. So now when we talk about accounting rate of return or return on capital employed, it's basically how much you are getting from the investment. You get it? Or the percentage you are getting from the investment. So assuming I invest, let's say 100,000 cedis into an investment, 10,000 cedis, 1,000 cedis, the percentage that I'm getting. So let's assume I invest 100 cedis in a project, or I invest 1,000 cedis in a project, the percentage that I'm getting out of the 100 cedis. So if there are two investments, and let's say investment one, I'm getting 15% profit or 15% as my accounting rate of return or the return on capital employed. And investment B, I'm getting, let's say, 20%. It means I have to go for investment B because I'm getting like higher profits. Do you get it? So basically, the accounting rate of return tells us the percentage of profit you are making. That's all. And it also doesn't consider time value of money as well. So let's take a question under accounting rate of return to see what it looks like. Okay, so this one is a bit long, so I'm going to read it. So it says, EcoBank decides to buy a printing machine for a printing press business. The cost of the machine is expected to be 80,000 cedis. The machine is expected to last for 4 years without any scrap value and is expected to be depreciated at 25% per annum on the straight line business. The following cash flows are expected. So we have year 1 to year 4. So for year 1, so we have the year and the profits before depreciation. So year 1, we have 20,000 cedis. Year 2, we have 25,000 cedis. Year 3, we have 35,000 cedis. And year 4, we have 30,000 cedis. And it says if the expected internal rate of return of the company is 25%, advise the company whether to buy the machine or not using the ROC approach or the return on capital employed. So what this question is basically saying is it's not anything difficult. It's just saying a company, which here they used EcoBank, wants to buy a machine for a printing press business. That's all. The company wants to buy a machine, and it says that the machine is expected to be 80,000 cedis, which is the cost of the machine is expected to be 80,000 cedis. And it's also saying the machine is expected to last for 4 years without any scrap value. Scrap value is the same as residual value. It means what is going to be left or the value of the machine after its useful life. You get it? So it means after 4 years, I think it says 4 years, it's going to last to 4 years. And after 4 years, if it has no scrap value, it means after the 4 years, you can't use it for anything. You get it? Some of there are other machines that maybe after 4 years, the scrap value might be 10,000 cedis out of the 80,000 cedis. Meaning that after the 4 years old, you can use it for some few things, but it won't be as good as compared to when you bought it. But this one, it says it has no scrap value, meaning once the 4 years has elapsed, you can't use it again. That's all. So scrap value is the value that you get after the useful life of the asset or the machine. So that's it. And it's saying that the machine is expected to be depreciated at 25% per annum on the straight line business. What this means is that every year it depreciates by 25%. This means that for year 1, the depreciation is going to be 25% out of what you got. Year 2 is going to be 50%. In year 1 and year 2 is going to be 50%. So you add both of them, 25, 25. Year 3 is going to be 75%. And year 4 is going to be 100%. So every year is going to be depreciated. Now the question is saying, based on the information that they've given to you, will it be good to buy it? Is it a good idea they actually go and buy the printing press machine, given the depreciation and everything? Or they shouldn't buy it? So they've given you the profits before depreciation for all the years, and they're asking us if we should buy it based on these profits. So let me write them on the board. So we have year 1, 2, 3, and 4. Then we have the profits before depreciation. Profits before depreciation. A year 1, we have 20,000. Year 2, we have 25,000. Year 3, we have 35,000. A year 4, we have 30,000. So this is the profit you are going to get every year. But remember, every year depreciation is going to occur. So this is before the depreciation. And before we actually know if it's a good idea to get that particular machine, we obviously have to calculate for the depreciation so that we subtract it from it. Then we know the actual profit we are getting from the machine. You get it? The aim of this whole thing is to see if it's a good investment or not. if rebuying the machine is going to be a good idea, the returns you are getting from it. So now we can't use the profit before depreciation because at the end of the day, it's going to depreciate. You get it? Meaning that if, let's say, we buy the machine, maybe in the first year, it can print, let's say, 1,000 copies in maybe 5 minutes. But in the second year, it can't do all of that. In the third year, it's going to reduce. So maybe if the first year it can print 1,000 copies, the second year maybe 75, the third year maybe 50 or something. You have to calculate all that so that every year what is given us or what the printer can give us, will it be a good idea based on the money we are going to get? Do you get it? So now the first thing we are going to do is to calculate for the annual depreciation, meaning that every year how much in terms of money does it depreciate. So how much are you going to be taking from it every year? They've already given us the percentage, but then we'll calculate it in terms of like proper money. So for annual depreciation, the formula is the cost of the assets. So please take note of the formulas. The cost of the assets minus the scrap value or the residual value. So the scrap value or the residual value over the useful life of the assets times 100. So anytime you get a question like this, you first calculate for the annual depreciation. The annual depreciation, the formula is the cost of the asset, meaning how much the asset is. Based on the question, they said the cost of the asset is 80,000 cedis minus the scrap value, meaning at the end of the 4 years, how much are you getting? The question, it says it has no scrap value, so the scrap value here is 0. But then for some questions, they're actually going to give you a scrap value, maybe 5,000, 10,000. So in case it's 5,000, you put it there, you don't put 0 there. Over the useful life of asset, how long the asset is going to last. And this one is set 4 years, so times 100. So let's input the values and see what you are getting for the annual depreciation. So the cost of the assets is 80,000 cedis minus the scrap value, which is 0, because the question said there's no scrap value. Over the useful life of assets, it says the assets will last for 4 years, so it's going to be 4 times 100. So let's do it on the calculator and see what we get. So we have 80,000 cedis minus 0 over 4. We're getting 20,000 cedis. Is equal to 20,000 cedis. And every time, please don't forget to add the units. Yes. So in case this one didn't really give, okay, this one they gave it to us as cedis, so the unit is 20,000 cedis. So this means that every year is going to be depreciating by 20,000 cedis. So if you calculate it very well, 20,000 cedis, then year 2 is going to be 60,000 cedis, which is 20,000 minus 60,000. And year 3 is going to be 40,000 cedis. So by the end of the year, since there's no scrap value, it's going to be 0. So that's what it means. So every year is going to be depreciated by 20,000 cedis. So now that we've got the annual depreciation, we can now calculate for the profit after the depreciation, which is the actual returns we are getting from it. And that's the main thing we are looking at. We don't really need the profits before depreciation for anything. So let's calculate. So the annual depreciation, let me write it at the top before I finish. The annual depreciation is 20,000 cedis. Let me put it at the top. So the annual depreciation is 20,000 cedis. So the annual depreciation is 20,000 cedis. So now since we have the profit before depreciation, we can just add the depreciation so that we subtract it from the profits before depreciation. So the depreciation every year is 20,000 cedis. So it means year 1 is going to be 20,000 cedis. Year 2 is going to be 20,000 cedis. So it's constant for every year. Then year 3 is also going to be 20,000 cedis. Then year 4 as well, 20,000 cedis. So now since you have the profit before depreciation and we have the depreciation, the next thing we're going to calculate is the profit after depreciation, which is the final profit you are making, how much you're actually getting from this printer. So we're going to get profits after depreciation. So let me just do PAD for short. Profits, or let me write the full one, profit after depreciation. This is how much you actually get. So the profit after depreciation is the profit before depreciation minus the depreciation. You get to the profit before depreciation. This was when it had not depreciated. Now this is the depreciation, so we are going to subtract it. So for year 1, 20,000 minus 20,000 will give you 0. So the profit after depreciation is, so mean year 1 we didn't really get any profit. That's what it means. So we didn't get any profit. Year 2, 25,000 minus 20,000, we are getting 5,000. So year 2, our profit after depreciation is 5,000. Then year 3, we have 35,000 minus 20,000. 35,000 minus, which is 15,000. So year 3, after it had depreciated, we got 15,000. Then year 4, 30,000 minus 20,000, we are getting 10,000. This is what it means. So now, this is what we get for the profits for each year. So year 1, 0, year 2, 5,000, year 3, 15,000, and year 4, 10,000. So now I'm going to add the profit for each year after the depreciation to know how much you're actually getting from that printer, to know if it's good or not. So when we add them, what do we get? So we have 5,000 plus 15,000 plus 10,000. We are getting 30,000. 30,000. So the profit after depreciation, this is what you're actually getting. We invested 80,000 and you are getting 30,000, which is our profit after depreciation. Now the question says, if the expected internal rate of return of the company is 25%, advise the company whether to buy the machine or not using the ROCE approach. The company says if the internal rate of return is 25%. So now we are going to solve for it using the ROCE approach. And the ROCE is the same as return on capital employed. And we did financial statements on this channel where we said return on capital employed, the formula is the profit before interest and tax over the capital employed. And the profit before interest and tax is the same as profit after depreciation. So keep it in mind, the profit before interest and tax is always the same as the profit after depreciation. And what is the profit after depreciation? So that's the total, which is 30,000. So you have 30,000 cedis. So our profit before interest and tax is the same as profit after depreciation over, so which is 30,000 over the capital employed, which is 80,000. The capital employed is the cost or how much you invested or the capital you invested into the business, which is 80,000. So at the end of the day, our return on capital employed is 30,000 over 80,000. We're getting 0.375. 0.375. And this one is always calculated in percentage because it's a rate. So 0.375 times 100. And let's see what you are getting. So 0.375 times 100. You're getting 37.5%. 37.5%. So what this means is that our return on capital employed is 37.5%. Meaning that out of the 80,000 cedis, 37.5% is profits after the depreciation. Or after all the interest and taxes, everything, when you subtract all those things, you are getting 37.5%. But the question said that if the expected internal rate of return is 25%, meaning they were expecting 25%, but we got 37.5%, which is more than the 25%, then we have to accept it. The question asked if we should accept it or not. So the question was asking if we should accept it or not. So yes, you are going to accept it since the 37.5% is more than the expected internal rate of return. You are going to accept it. Assuming we got 24% or anything less than 25%, then we wouldn't accept it. If it was 23%, 22, 19, 18, 7 or something, we won't accept it. But since it's more than the question's expected internal rate of return, we are going to accept it. So that's it for the return on capital employed. Now, they can also give you a question on the accounting rate of return where they can ask you to use the initial investment method or the average investment method. So let's look at that one for now. So you're done with the ROC. So let's look at the initial investment method and the average investment method in case it comes in exams. Now, done with the return on capital employed, you're going to look at the initial investment method and the average investment method under the accounting rate of return. Now, the initial investment method looks at how much you are going to get using the initial investment or how much you put in it. So if you put in 80,000 cedis, how much are you going to get? Or the percentage of the 80,000 cedis that you are going to get. You get it. But for the average investment method, it looks at how much, assuming every year there's going to be depreciation. Every year there's going to be depreciation. So in case maybe the first year you bought it at 80,000 cedis, that's the first year you bought it at 8,000 cedis, but then the second year it's going to depreciate. So assuming it depreciates by 20,000 cedis, it means the second year is going to be 60,000 cedis, and the third year to minus another 20,000 cedis, so 40,000 cedis. So it's looking at the average, like every year. So assuming you bought it in year 2, what would have been the returns? Assuming you bought it in year 3, what would have been the returns? You get it? But for the first one, it only looks at how much you bought it and the returns you are going to get. But for the second one, which is the average investment method, it's looking at the returns for each of the years. You get it? So assuming you bought it for each of the years, assuming you bought it in year 2, year 3, whereas depreciating has been subtracted, what would you have been getting, or the returns you would have been getting from it? That's the average investment method. So let's take a question under initial investment method and the average investment method so that you understand it better. It says a company is considering a project which requires an investment of 120,000 cedis in machinery. The machinery will last for 4 years, after which it will have a scrap value of 20,000 cedis. The investment in additional working capital will be 15,000 cedis. The expected annual profits before depreciation are, so we have year 1 to 4. They've given us the annual profits for each of the years before depreciation. So year 1 we have 45,000 cedis, and year 2 we have 45,000 cedis as well, and year 3 we have 40,000 cedis, and year 4 25,000 cedis. And it says the company requires a minimum accounting rate of return of 15% from projects of this type. Calculate the ARR using the initial investment method and the average investment method. And should the project be undertaken? Okay. So this one, you've got a question from both the initial investment and the average investment method. So in case a question like this comes in exam, this is how you're supposed to go about it. So now, the first thing we are going to do, just like the return on capital employed, is to calculate for the annual depreciation. Anytime a question comes like this, make sure you calculate for the annual depreciation. The first thing you're going to do. And the formula for the annual depreciation is, so just like we did for the return on capital employed, it's the same formula. So it's the cost of assets or the investments minus the scrap value over the useful life of assets. This is the formula for the annual depreciation. So the cost of assets is 120,000 cedis from the question. But see, the company is considering a project which requires an investment of 120,000 Ghana cedis minus the scrap value. And the question says it has a scrap value of 20,000 cedis. 20,000 cedis over the useful life of the asset, which is 4 years, because 1, 2, 3, 4. So the number of years you see there is the useful life of the assets. Now let's calculate for the annual depreciation. So you have 120,000 cedis minus 20,000 cedis over 4. You are getting 25,000 cedis. 25,000 cedis. So our annual depreciation is 25,000 cedis, meaning that every year it depreciates by 25,000 cedis. That's what it means. So now let me write the profit before depreciation here. So here, then 1, 2, 3, 4. Then we have the profits before depreciation. So we have 45,000. We have another 45,000. Then year 3 we have 40,000. And year 4 we have 25,000. So this is what the question has given as the profit before depreciation. And now we've calculated for the annual depreciation. So the depreciation, which is the same as the annual depreciation, is 25,000 cedis. So it means year 1 25,000 cedis, year 2 every year is 25,000 cedis. So the depreciation is 25,000 cedis, 25,000 cedis for year 2, 25,000 cedis for year 3, and 25,000 cedis for year 4. Then now I'm going to look at the profit after depreciation, which is the actual profits we are going to get. So we have the profit before depreciation and the depreciation. So to get the profit after depreciation, we'll just take the depreciation from the profit before depreciation, then get the profit after depreciation. So the profit after depreciation. So let me just do PAD to save space. So profit after depreciation, which is the actual profit you are going to get. So for the first year, we have 45,000 minus 25,000, which is 20,000. So it means year 1, the profit you're actually going to get after it has depreciated is 20,000. Then year 2, we have 45,000 minus 25,000, which is also 20,000. Then year 3, 40,000 minus 25,000, which is 15,000. Then year 4, 25,000 minus 25,000, which is 0. You get it? So these are the profits after depreciation for each of the years. So now I'm going to add all the profits after depreciation to see the actual profit you are making from this investment. Do you get it? I'm going to add all of them. So when we add 20,000 plus 20,000 plus 15,000, we're getting 55,000. So our total profit after depreciation is 55,000 cedis. Meaning that this is the actual profit you are getting from this particular investment. So for all the 4 years. So now the question says we should use what the question say? So we should this project be undertaken using the initial investment method and the average investment method. So let's start with the initial investment method. So let me clean this one so we know the annual depreciation is 25,000. So let me just write it here. So annual depreciation is equal to 25,000. So now let's start with the initial investment method. So for the initial investment method, the formula for the ARR is the average annual profits over the initial investment times 100. Since it's rate, so we want to get a rate. So for the formula for the ARR using the initial investment method is the average annual profit over the initial investment times 100. So what is the average annual profit? So the average annual profit is 55,000 over 4. Because this is the profit you are getting for all the years. We want to see the average, meaning every year, what are we likely to get? Looking at all of them, you get it. It's like you have like maybe the ages of like 4 people. Maybe this person is 13 years, 14 years, 15 years, 16. But you want to see the average age. You get it. You add all of them over the number of people there. So this comes to the total profit over the number of years. So the average annual profit will be 55,000 over 4. So let's do 55,000 over 4. We're getting 13,750. So the average annual profit is equal to the total number of years, which is 55,000. Sorry, the total number of profits in the year, 55,000 over 4. So we have 13,750. Every year, averagely, you are making 30,750 after subtracting depreciation. You get it. So now we have our average annual profit. It's less than initial investment, which is already given in the question. The question says the cost is 120,000 cedis. So the initial investment is just the cost, and it's always stated in the question most of the time. So now our ARR using the initial investment method is the average annual profit, which is right here. So 13,750 over the initial investment, which is the cost, which is 120,000 Ghana cedis times 100. And what do we get? Let's do this on the calculator and see what we get. So 13,750 over the 120,000 times 100. You are getting 11.46%. 11.46%. The question said, should this project be undertaken using both of the methods? So using the initial investment method, so the question gave us a minimum accounting rate of return of 15%. And what we got is 11.46%, meaning that it's below their minimum. So we can't accept it. So assuming it's exams, we are going to see the project should not be undertaken simply because it's below their minimum accounting rate of return. That's all. It's below. So once it's below the 15% they provided us in the question, then we are not going to accept it. So that's just for the initial investment method. But if we calculate for the average investment method and it's more than 15%, they are going to accept it using the average investment method, but not with the initial investment method. You get it. So now let's go to the average investment method. So let's clean So for the average, I'm just going to change this one. So the average investment method. So average investment method over the average. So everywhere you see initial, you just change it to average. So ARR is the average annual profit over the average investment times 100 for the average investment method. So now it's no more the initial investment, it's over the average investment. And now we've already calculated our average annual profit, which is 13,750. So now we only need to calculate for the average investments and input the values. So what is the average investment? The average, so I'm just using AI here for average investment because of space. The average investment is the costs, the cost of the investment, or how much you're investing in the investment plus the scrap value over 2 plus the working capital. So let me write the formula here. I think it won't go here. So average investment is the costs plus the scrap value over 2 plus the working capital. So the WC is the working capital, yes. So in exams, you write it in full because of space. That's why I'm not. So the cost, and the cost in the question is 120,000 cedis. So you have 120,000 cedis plus the scrap value, which in the question it says it has a scrap value of 20,000 cedis. So 20,000 cedis over 2 plus the working capital. So the question gives us a working capital of 15,000 cedis. So 15,000 cedis. So now let's calculate it and see. So we have 120,000 cedis plus 20,000 cedis over 2 plus 15,000. So we have 85,000. So meaning our average investment is 85,000 cedis. 85,000 cedis. That's what it means. So now we have our average annual profits, which is the 13,750, and our average investment, which is 85,000 cedis. So we just do 13,750 over 85,000, which is the average investment times 100. So let's do it somewhere here. We can do it here. So 13,750, which is the average annual profit, over 85,000 times 100. Let's see what you are getting. So 13,750 over 85,000 times 100. So you are getting 16.18 to 2 decimal places. So 16.18%. So for the initial investment, I think we got about the initial investment, we got 11 point something, but this one are getting 16.18%, which is more than their minimum. Their minimum was 15%. They say the minimum accounting rate is 50%, but this one is more than 15%. So we are going to see the project should therefore be undertaken since it's more than their minimum accounting rate of return. So for the initial investment method, you are not going to accept it, but for the average investment method, you are going to accept it. So if you see any question on return on capital employed or the average investment method or the initial investment method, this is how we're going to go about it. Very simple. So yeah, so that's it for the accounting rate of return and the non-discount approach as well. Now we're going to look at the discount approach, which are the approaches that consider the time value of money. So let's look at them.